This calculator compresses what's taught over years of real estate finance classes into a 7-minute lesson, and now we're going to use it. This next section works best with the follow-along calculator open. It's the same tool used in every example, and this calculator is designed to be open and adjusted live. You don't need to set anything up, you don't need to sign in, you just download it, or you can use it live on the website and follow along. So download the calculator and keep it next to you. We're going to start with the first example now, and we're going to walk through this together. Let's start with annual income. Before forecast, before financing, before assumptions, we look at what the property earns in a year. Income is the foundation, and that income is priced by the market. Depending on the neighborhood, that price changes. Safer areas trade at higher multiples, and riskier areas trade at lower ones. When you multiply annual income by the market multiple, you get a first indication of what the property is worth. That isn't the final value, it's a sanity check, and a way to see whether the deal makes sense before you go any further. And that's why we start here. Now let's put the numbers into the calculator and see how it works. Now let's talk about how professionals screen an income property. They don't start with forecasts, they don't start with finance, they start with gross income, and here's why. Annual income is easy to verify, and the income is priced by the market. That pricing shows up as the gross rent multiplier, or GRM. And in this example, the property earns $108,000 a year. The market trades at about a 9.6 GRM, so we multiply 108,000 times 9.6. That gives us a first pass value. That isn't the final answer, it's just a screen. A fast way to see if the asking price even belongs in the conversation. Professionals use the GRM first because it exposes pricing quickly, and students benefit from it because it forces discipline before assumptions creep in. If it doesn't work here, it won't work later. Now let's walk through it in the calculator. This is why operating expenses come next. Before financing, before leverage, we need to know what it costs to run the building. And once expenses are entered, the calculator does the rest. Total operating expenses are subtracted from gross income, and what remains is net operating income, or NOI. As a quick check, we look at the operating expense percentage. Total operating expenses divided by gross operating income. This tells us whether the expense load makes sense for the type of property and the market. Now that we have NOI, we can move on to what really matters next. For the loan, we use a simple Excel calculator. You don't have to build anything. All you do is enter the loan amount and the interest rate. Once those inputs are in, Excel does the rest. It calculates the annual payment and the interest portion and the principal pay down automatically. And because it's all in Excel, you can adjust the loan and immediately see how coverage changes. This keeps leverage grounded in math and not assumptions. And now that we know the payment, we can test the coverage and see whether the structure actually works. Let's talk about the cap rate. The cap rate measures what the building earns on its own. It's income-based, and the formula is very simple. It's net operating income divided by the price. So in this case, the $60,400 is divided by the $1 million price, and that's a 6% cap. What this tells us is what the property itself earns before the finance is introduced. Now here's why that matters. If the cap rate is lower than the loan rate, the leverage is negative. But if the cap rate is higher than the loan rate, leverage becomes positive, and the income supports the debt. And that's why the cap rate comes before the financing. Depreciation allows income property to generate cash flow while reporting a tax loss. It does not change how much cash the property produces. It changes how that cash is treated for tax purposes. After operating expenses and financing, depreciation is applied on the building value only, not the land. This creates a non-cash deduction that can offset income, often turning modest positive cash flow into a taxable loss. And that loss then produces a real tax savings, depending on the investor's tax bracket. Now we can talk about total return, not as one number, but as a structure. There isn't a single source of return here. The result comes from multiple streams working together. Cash flow is one part. It tells us the income that supports the loan, and depreciation is another. It doesn't change cash, but it improves the after-tax outcome. Loan paydown builds equity. Each payment reduces the loan balance and increases your ownership. And appreciation sits on top of the entire stack, magnifies everything. For better or for worse, the total annual return is the combination of these effects. Cash flow plus equity growth plus tax structure. If any one piece fails, the structure weakens, but when they work together, the result compounds, and that's why we don't chase one single metric. Now we test debt coverage, and this is where the leverage either works or it breaks. The debt service coverage ratio compares income to the loan payment. In our example, the net operating income is $60,400 and the annual loan payment is $59,877. When we divide the two, we get a coverage ratio of 1 to 1. The income barely covers the obligation, and most lenders want more, typically a 1.2 or better. So the math isn't wrong, the structure's just too tight. Now let's look at 3 ways we can fix this. When coverage is close to 1 to 1, the problem isn't subtle. The income is doing just enough to cover the loan. That's not a buffer, that's exposure. Below the debt service coverage ratio of 1.2, the deal isn't comfortably supported by income alone. And at that point, we don't debate the math, we adjust the structure. There's only 3 levers that actually change the coverage: the price, the down payment, and the building income. Everything else is cosmetic. In the next examples, we'll fix the structure step by step and watch the coverage ratio move back above the line. Let's fix the structure by adjusting the price. In this example, we lower the offer price from $1 million to $875,000. Nothing else changes. Same building, same income, same expenses, but the loan gets smaller, and that lowers the annual payment and improves the coverage. The debt service coverage ratio moves from 1 to 1 to about 1.2, and that's comfortably above the line. Notice what else happens. The cap rate improves, and that's because the structure is stronger. The total yield improves as well. And this is why price matters. Lowering the offer price improves the coverage, improves the yield, improves the durability. If the seller accepts it, the math works. If not, we move to the next lever. Now let's fix the debt service coverage ratio in a different way. Instead of lowering the price, we increase the down payment. The purchase price stays at $1 million, but the down payment moves from $250,000 to $370,000. That reduces the loan and lowers the debt service. The debt service coverage ratio now jumps to 1.2. Coverage is no longer the issue. The building itself earns the same amount, but the cash flow increases because the loan is smaller, but now the leverage decreases. And that shows up in the total yield. It falls from 17.6 to 13.4. The deal is safer, but it's less efficient, and that's the trade-off. Higher down payments reduce the risk, but they also reduce the leverage and the overall return. And this is why we need to compare the structure instead of just chasing one single number. This is the part most people miss. A modest rent increase can have a dramatic effect. On the left, the income increase is priced by the market, and that creates equity, about $29,000 in this example. And on the right, the same income increase improves debt coverage. Stronger coverage means the property can support more debt, about $32,000 of additional loan capacity. Nothing aggressive happened, rent moved normally, the structure did the work. And this is why a small rent growth matters over time, not because it feels big, but because the effects compound in more than one place. You can structure a deal. You now know how to use the calculator to see whether a deal works before committing. You can test the assumptions yourself. Instead of relying on opinions, you can change the numbers and see the impact immediately. You can walk into a deal with confidence when you understand the structure. You'll know more than the agent on the other side about whether the math actually works. People often ask how I think about real estate deals, and the answer, it's not intuition, it's not forecasting, it's not opinion. I start by asking whether the structure works. If the income supports the loan, if expenses are realistic, and if small changes improve the outcome mechanically, the deal's worth continuing. If it doesn't work at the structure level, no story fixes it, and that's the lesson you just learned.